Hello, this is Domenico with Easynomics, and this will be an additional video illustrating a fixed exchange rate system. In this case, we're going to look at the Egyptian pound as an example. It will not be perhaps an 100% accurate historical example, but we're just going to use it to illustrate how a central bank can maintain its pegged or fixed exchange rate. We'll notice that with Egypt, it has a trade deficit. In this chart, we can see that it is importing more than what it is exporting. And we can also see that after 2011, from the Egyptian revolution of 2011, there's sort of a downward trend going from 2011 to 2014, highlighting that the trade deficit is getting a little bit larger for Egypt, that they are increasingly importing more than what they're exporting, and it slightly improves up until 2018, it declines, and then it rises. But we're going to focus in this period right here, from the Egyptian revolution period of 2011 to perhaps about 2014, that downward trend where, as I said, Egypt is importing more than what they are exporting. So the Egyptian revolution of 2011 definitely caused disruption in terms of their trade and also disrupted their ability to export. And we're going to use that as our example. And in addition, we're going to look at Egypt's central bank resorting to import controls in order to prop up their currency in the foreign exchange market. Okay, so these are just some contextual examples. This is not 100% accurate in terms of its application to the model, but it's just going to be used to illustrate a fixed exchange rate system. Okay, so here we have graph A. It's the market for Egyptian pounds in the foreign exchange market. We have a downward sloping demand for Egyptian pounds and an upward sloping supply for Egyptian pounds. Now we want to note that the central bank has four methods that they can use to intervene to maintain a fixed exchange rate. One is the use of foreign reserves, which is the example that I used in the previous video when we looked at Thailand and the Thai central bank pegging their currency to the US dollar and using their foreign reserves of perhaps dollars, selling those dollars into the exchange rate to demand Thai baht to prop up its value. So we've already used this example. Other methods could be if the currency is depreciating in the foreign exchange market and the central bank wants to revalue that currency or increase its value, they can increase interest rates within their country, basically engaging in contractionary monetary policy. And let's say, for example, country A is offering interest rates of perhaps about 5% versus country B, which is offering interest rates at 1%. So if an investor has, let's say, $1 billion and they haven't decided on what to invest in, they may look for ways to park their cash in a savings account and accumulate an interest rate on that amount. So if country A wants to increase demand for their currency, they can engage in contractionary monetary policy, raising interest rates to 5%, and that would attract investors to sell off their currency, buy into country's A currency, open an account, and take advantage of that higher interest rate versus country B. Okay, so perhaps investors in country B selling off their currency, buying into country's A currency, opening an account in a bank, and just parking their cash in that account and collecting 5%. So that's one method. Another is, number three, borrowing from abroad, basically taking loans in the form of foreign exchange. Perhaps, let's say, Egypt borrowing US dollars and using those dollars to influence their currency in the foreign exchange. They can take those dollars, sell the dollar, demand the Egyptian pound, and increase the value of the Egyptian pound. But the negative aspect of this is that they have to repay those foreign loans in the currency that they borrowed from. So they're going to have to pay it back if it's in dollars, back in dollars. So if the Egyptian pound, in this case, loses value, it's going to be increasingly more difficult for Egypt to pay off its foreign debts. And the last example, which is the one we're going to use for our example, is to limit imports. Limiting imports, so that reduces the outflow of your domestic currency into the foreign exchange. Okay? So let's go ahead and illustrate this. So here we have the central bank perhaps wanting to maintain the value of the Egyptian pound to euros at E1 with the quantity supply and demand at Q1. S1 equals D1 provides that equilibrium, right? Just basic analysis as we've done, where S1 equals D1, it provides the equilibrium exchange rate at E1 and the equilibrium quantity supplied at Q1. Then we have the 2011 revolution, and let's just assume that it disrupts Egypt's ability to export. And as a result, let's assume that there's decreasing demand for Egyptian pounds since it's not going to be exporting as much due to the political unrest. We're just going to make that assumption. So demand for the Egyptian pound falls from D1 to D2 due to demand falling for its exports. Okay? And as we've done before, we're going to illustrate in the short run the currency being held constant at E1. We have the quantity demanded going to Q2, quantity supplied at Q1, right? Quantity supplied at Q1 greater than the quantity demanded. That puts downward pressure on the value of the currency, so it begins to depreciate. And starts to depreciate to point C. Establishing a, let's say, long-run equilibrium exchange rate at E2 with a quantity supplied and demanded at Q3. Okay. The Central Bank of Egypt wanting to prevent the fall in the Egyptian pound as a result of the decreased demand for their exports, leading to decreased demand for their Egyptian pounds, decides to put in an import control. So again, as we see here, Egypt central bank will tighten import regulations, making it more difficult for local importers to import goods, perhaps from the European zone. And they're doing this because they want to prevent the outflow of the Egyptian pound from going to the foreign exchange to demand euros to buy the European goods and services that will be imported into the country. So those import controls will prevent the supply of Egyptian pounds from leaking into the foreign exchange. Thus, we can say that the supply of Egyptian pounds will fall from S1 to S2. Thus maintaining the peg at E1. All right, from S1 to S2, the supply of Egyptian pounds in the foreign exchange market decreasing due to the decreased amount of imports coming into the country, which leads to Egyptians not selling off the Egyptian pound, reducing the outflow of Egyptian pounds into the foreign exchange. Thus, the supply shifts in. So here we have demand for Egyptian pounds shifting in, and the central bank responding by reducing the supply of Egyptian pounds through the use of limiting imports, thus maintaining that peg. Okay, so now we're going to go ahead and analyze this as we would for a paper exam. All right, just highlighting that here is where the fixed peg is being maintained, just making that assumption. So as can be seen, we have graph A illustrating the market for Egyptian pounds in the foreign exchange market. We're measuring quantity of Egyptian pounds on the x-axis and the value of pounds in terms of euros or euros per Egyptian pound on the y-axis. We have a downward sloping demand for Egyptian pounds at D1 EGP, Egyptian pounds, and an upward sloping supply for Egyptian pounds, S1 EGP. Where S1 equals D1, it provides an equilibrium exchange rate at E1 and equilibrium quantity supply and demand at Q1. But due to the 2011 revolution, it disrupts Egypt's ability to export. Demand for exports falls, thus the demand for the Egyptian pound falls from D1 to D2. We will hold the value of the Egyptian pound constant at E1, and at point B, or at Q2, we see that the quantity demanded is less than the quantity supplied at Q1. Thus, it puts downward pressure on the Egyptian currency to fall from E1 to E2. And as it falls, the quantity demanded increases along the demand curve, according to the law of demand, from point B to point C, while the quantity supplied also decreases. Quantity demanded increases from point B to point C, according to the law of demand, from Q2 to Q3, and the quantity supplied decreases from point A to point C, or from Q1 to Q3, establishing a long-run equilibrium at point C. Where at point C, we see that where S1 equals D2, it provides the long-run exchange rate at E2 with a new quantity supply and demand at Q3. But the central bank wants to prevent that depreciation. They want to maintain the value of the currency at E1. So they engage in limiting imports. They put restrictions on the amount of Egyptian pounds that can be converted, let's say, into euros to buy European imports. So those restrictions reduces the amount of imports coming into the country, which reduces the outflow of Egyptian pounds going into the foreign exchange. So the supply of Egyptian pounds then decreases from S1 to S2, and we see that where S2 equals D2 at point B, it raises the value of the currency back up to E1. And at S2 equals D2, it maintains an exchange rate of E1 with a new quantity supplied and demanded at Q2. Okay? So that's another way to illustrate a pegged exchange rate. If you have any questions, feel free to comment, and don't forget to subscribe and to like. Thank you so much.